All right, so you've been sending in some seriously interesting sources lately, and it seems like you're ready to dive deep into company fundamentals for investing.
Yeah, that's awesome to see.
Smart move, especially as you're building your financial know-how. Consider this deep dive your express lane to mastering this stuff.
Definitely.
Our goal today is pretty simple, really. We're going to break down the financial inner workings of companies so you can make smart, informed investment decisions and really, take control of your financial future.
It's all about empowerment, right?
Exactly.
And independence. Investing without understanding a company's financial health can feel like walking a tightrope blindfolded. This deep dive is all about handing you a safety net. Uh, I mean, a solid compass to navigate the market.
I like that.
So you can figure out if a company is a good investment with solid returns and manageable risk.
Perfect. So let's jump right in. The foundation of understanding any company from an investment standpoint is their financial statements.
Absolutely.
These are basically the heart of fundamental analysis, right?
Yeah.
They give you this whole picture of a company's health, profitability, and how well they handle their immediate, financial obligations.
Their liquidity.
Yeah.
Now, we got three main statements to explore here.
Okay, so let's break them down.
All right. The first one, the balance sheet. Think of it like a snapshot, frozen in time, showing what a company owns and what it owes at that specific moment.
Okay.
It lists all the company's assets, everything they have, and all their liabilities, everything they owe to others.
Gotcha.
And the difference between those two, that's shareholder equity. It represents the owner's stake in the company. What's really insightful here is how assets and liabilities relate to each other.
Okay.
If a company consistently has more assets than liabilities, it gives them flexibility, crucial flexibility, to handle tough economic times or jump on new opportunities without, relying too heavily on borrowing.
So it's not just about avoiding debt, it's about being prepared.
Exactly. It's about long-term resilience, that ability to bounce back and thrive.
I see. Makes sense. It's about building that financial cushion for the future. All right, let's move on to the income statement. What does that tell us?
Think of the income statement as a company's financial report card. It shows their performance over a set period, like a quarter or a full year.
Okay.
It starts with the revenue generated from sales and then subtracts all the costs involved in making those sales. What you really want to look at here isn't just whether they made a profit or loss, but the trend of their profitability over time.
So, are they consistently profitable?
Exactly. And how sustainable are those profits? Don't just focus on the bottom line. Look at their gross profit margin and operating profit margin too. Those can reveal a lot about the efficiency of their core operations.
Right. So it's not just about making money, it's about how they're making money and if that can keep going. Makes sense. And then there's the cash flow statement. We touched on this earlier, but how does it give us a different perspective than just profit?
The income statement shows the potential to make money, but the cash flow statement reveals the actual cash flow in and out of the business.
Yeah.
A profitable company can still run into trouble if they don't manage their cash effectively.
Right.
Imagine a business with tons of sales on credit, but customers are slow to pay. That can create a cash crunch. The cash flow statement tracks the movement of cash from operations, investments, and financing activities. Positive and consistently growing cash flow from operations.
Yeah.
That's a strong sign of a healthy business that can fund its growth and potentially reward investors.
So the financial statements give us the hard number, the data, but there's more to a company than just its balance sheet, right?
Yeah, definitely. You need to understand what the company actually does. That's where the business model and market position come in.
Okay, so what are we looking for here?
Dig into those fundamental questions. What products or services do they offer? Who are they selling to? Who are their target customers? How do they make money? What are their revenue streams?
Okay, that makes sense.
And crucially, what sets them apart from the competition? Do they have unique technology, a strong brand, or a cost advantage?
Right, what's their edge?
Precisely. We're looking for companies with a sustainable competitive advantage. Warren Buffett calls this a moat.
A moat. I like that.
This moat gives them pricing power and makes it harder for competitors to, steal their market share. That can lead to stronger performance over the long term.
It's about what protects their business, what keeps them ahead. Makes sense. So we've looked at the financials, the business model, but what about the people at the top? Doesn't leadership play a huge role?
Absolutely. That's why management and corporate governance are so important. The leadership team sets the tone and direction for the entire company.
True.
You want to look into the experience and track record of those key executives. Have they successfully navigated difficult situations before?
Right. Have they been tested?
Exactly. But it's not just about individual brilliance. We also need to consider the company's corporate governance, the rules and systems that ensure accountability and protect shareholders.
Okay.
Are there independent members on the board? Is executive compensation aligned with long-term shareholder value? These are signs of a well-managed, ethical company.
So it's about aligning the interests of management with the interest of the investors.
Exactly.
Makes sense. All right, so we've covered the internal workings, financials, business model, and management. But companies don't exist in a vacuum, right?
Nope. They're part of a bigger ecosystem. And that's where industry and economic factors come in.
Okay, so what do we need to consider here?
Zoom out and look at the big picture. What trends are shaping the industry? Are there any major regulatory changes coming down the pike?
Hmm, interesting.
What about disruptive technologies? Could they threaten the company or create new opportunities?
So many factors.
And of course, the overall economic climate matters big time. Interest rates, inflation, consumer confidence, all these things can impact a company's profitability and growth potential.
Yeah, it's like understanding the currents the ship is sailing in, not just the ship itself.
Exactly.
Yeah.
Understanding these macro factors helps you assess whether a company is well positioned to thrive within its industry and navigate the broader economic landscape.
So we've talked about the importance of focusing on company fundamentals, but you mentioned some key figures who really championed this approach.
Yeah, their stories really underscore the power of this approach. First, there's Warren Buffett, a name synonymous with long-term investing success.
Oh, yeah, definitely.
His entire strategy revolves around deeply understanding company fundamentals. He's known for his patience and ability to spot undervalued companies with strong, durable businesses.
Right, he's the master of finding those hidden gems. And the other name that kept popping up was Benjamin Graham.
Ah, Benjamin Graham. He's considered the father of value investing.
Right.
His book, The Intelligent Investor, it's like the Bible for fundamental analysis.
Wow.
He emphasized buying stocks for less than their intrinsic value, carefully analyzing a company's financials and business to determine that value. Both Buffett, who was actually a student of Graham's, and Graham himself have demonstrated how effective this fundamentals-focused approach can be over decades.
It's amazing how these principles have stood the test of time through so many market ups and downs. The sources also mention some pretty unbelievable facts that really illustrate these principles in action.
Oh yeah, those are fun. Like, take Warren Buffett again. Despite his massive wealth, he still lives in the same relatively modest home he bought back in 1958 for just $31,500.
Wow.
What's striking is how his personal discipline and focus on value mirror his investment philosophy. He doesn't get swayed by trends or fads, whether in his personal life or his investments. It's a powerful testament to consistency and focusing on what truly matters.
It really shows it's not about getting rich quick, it's about building lasting value.
Exactly.
And then there's the incredible streak of one of his favorite companies, Coca-Cola.
Ah, yes, Coca-Cola.
Yeah.
They've increased their dividend payout to shareholders every single year for over 6 decades.
Seriously, every single year.
Every single year. That kind of consistent growth in returning value to investors comes from a fundamentally strong business that generates reliable profits year after year. It's a tangible example of the long-term wealth-building potential of investing in companies with solid fundamentals.
That is a seriously impressive track record. So, as our listener is starting to build their financial future, what's the key takeaway from all of this?
The bottom line is that understanding company fundamentals isn't just a nice to have, it's essential for successful investing. It allows you to move beyond speculation and make informed decisions based on a company's true worth.
Right.
By analyzing their financial health, business model management, and the bigger industry and economic context, you can manage risk more effectively and boost your potential for long-term financial success and independence.
So, instead of just following the crowd or chasing the latest hot stock, this approach gives you a solid framework to evaluate opportunities and make confident choices with your money.
It's about becoming financially literate, understanding the language of business and investing. And as you navigate the financial world, especially with your own goals and ambitions, this understanding of company fundamentals becomes your most reliable guide.
Your compass. I love it. So, moving forward, what would you recommend our listener do to put all of this knowledge into practice?
Take these insights and start applying them. Look at companies that interest you, peek under the hood, and examine their fundamentals.
Do your homework.
Exactly. Start making investment decisions based on knowledge and understanding rather than just hype or hope.
be an informed investor.
Absolutely. And here's a final thought to chew on. Given those powerful examples of long-term success built on fundamental investing,
Mhm.
what are some well-established, maybe even seemingly boring companies and industries you understand that might have those same strengths? It might be in those often overlooked corners that you uncover some truly compelling opportunities.
Food for thought. Awesome. Thanks so much for breaking all of that down for us. Super helpful.
My pleasure. Glad to be here.
And to our listener, we'll catch you on our next deep dive. Keep those sources coming.
Keep learning.
Until next time.
See you then.